Step 1, 2, 3, test. Test. 1, 2, 3, test.
Hi, Stuart.
Hello, Jean. Can you hear me?
I can hear you. I just let everybody into the room. So
Okay.
I've done the intro. Yes, you can take it away.
Jean, you're kind of cutting out a little bit. I'm sorry.
Yes. Stuart, the introduction has been done. You can start.
Okay, you want to get started? I'm sorry, I could barely hear you. Okay, so good afternoon, everyone. My name is Stuart Guthrie with the Liberty Group of Nevada. We are an M&A and business valuation practice operating primarily in Nevada and California. Catherine can't be here today. If she were here, you'd notice immediately that I overmarried. She's both a CEPA, that is a Certified Exit Planning Advisor, and a Value Builder Advisor. Rest assured, she had a large role in developing this presentation. Our business relationship over the last 25 years or so has been that I'm the sales guy and she runs ops. So her job over the last many years, 3 businesses, has been to fulfill my promises. Next slide, please. Today's presentation is entitled From Valuation to Value. Now, our conversation will mostly come from the perspective of selling a business as an exit plan, but I sincerely believe that everything we talk about today applies to all businesses, regardless of your desire to sell. Anyway, we're here to talk about the difference between valuation and value and hopefully how to get those numbers a little closer together. While a valuation can be useful, it doesn't say much about value, which for today's meeting we're defining as how much money ends up in your bank account at the end of a sales transaction. Next slide, please. The delta between valuation and value can be surprisingly large, and frequently it's disappointing. For those of you who aren't really considering an exit anytime soon, let me emphasize that exit planning, which is really what we're talking about here today, is just good business planning. All the characteristics that make a business valuable, easier to manage, more profitable, resilient, are identical to the characteristics that would make you want to keep it. The day you walk into your business and say to yourself, why would I ever sell this? This is fantastic, is exactly the day you should list your business for sale, because buyers will pay a premium. Buyers will pay a premium for that. Next slide. Okay, so here's our guidelines for the next 40 minutes or so. We're going to explain what a valuation is and where you can get one. We're going to talk about what buyers are looking for in a business and how that impacts value. We're going to beg you to start the exit planning process yesterday, or at least start thinking about it. And we're going to talk about who should be on your team. We'll finish with some Q&A. So now on some level setting. Next slide. What is a valuation? According to NACVA, that's the National Association of Certified Valuators and Analysts, a valuation is the act or process of determining the value of a business enterprise or ownership interest therein. Next slide. The work product will be a value, or it's a range of values in a paper or electronic report, where typically the median value is bolded and represents a value where 1/2 the comp businesses sold for a higher multiple and 1/2 sold for a lower multiple. The median value is the most probable selling price. Next slide. So where and how do you get a valuation? I'm going to outline 3 ways to get them and what their respective pros and cons are, at least from my perspective. 1, self-service tool online tools. The pros, free 99, my favorite price. With care and some training, they can absolutely be accurate, and you don't usually have to interact with anyone. You can do it at 3 o'clock in the morning, though you're likely to add yourself to a whole bunch of new mailing lists if you do. Next slide, please. The cons? Well, as with any self-serve option, we're always concerned about garbage in, garbage out. If the business owner doesn't do this every day, there's a really good chance that the report's being based on inaccurate information. These reports can't provide any context regarding business attractiveness or readiness. And finally, our experience is that humans in general are generally bad at coaching or judging themselves. We give ourselves the benefit of the doubt, warranted or not, way too often. Next slide, please. You can get a valuation from an advisory professional, and typically that's going to be a business broker, an accountant, or a financial planner. The pros, again, it's free. Depending on who's doing the valuation, they absolutely can be accurate. The cons, they're usually a way to get you to use their services. But this isn't necessarily a con, but we need to recognize there's an incentive structure in place here. The value can be skewed by any number of factors. Maybe they'd like you and just want the best possible value for you. Perhaps they need a listing this week, or maybe they prefer to list businesses that will sell quickly, meaning that they're going to lean towards a more aggressively priced business. Next slide, please. Paid valuations, where the analysis is performed by a specialist or a certified valuation analyst. And what I mean by that is that the person doing the valuation is not someone who will benefit in any way from getting the listing or getting a sale. The pros, they're unbiased. They don't care about your hurt feelings, nor do they care if the business is listed. Specialization. We believe that there are real benefits and advantages in specialization, division of labor. Valuing a business is a different skill set than providing tax advice, negotiating a sale, or providing financial planning, and it takes a different set of tools. If the analyst is certified, the valuation is generally performed to a recognized standard, whether, again, NACVA or ASCPA, and they maintain that certification through ongoing professional education. They have usually invested in tools, multiple transaction databases, specialized software, et cetera, that make them more efficient. And the valuations can, though not always, include industry benchmarking and financial ratio analysis. This makes the valuation more useful to a business owner if you're getting the report for a strategic planning purposes, though benchmarking is useful if you're going to package the business for sale as well. And if you're willing to share the valuation, it can improve the confidence of buyers, investors, and lenders. The cons, well, of course, you're going to pay. So that's an overview of valuations. Let's talk about value. Next slide, please. What is value? So for the purposes of the meeting, again, we're going to define value as the amount of money the business owner or seller ends up at the end of an arm's length transaction. What I mean by arm's length is that you're not related to the buyer in any way. Next slide. Or the way you've likely heard it put it this way: your business is worth what someone is willing to pay for it. And if you remember nothing else from this webinar, please take a picture, write this down. No matter what the valuation says, if your business is not attractive and ready, you're most likely going to sell at a steep discount or potentially not sell at all. So how is it possible the valuation and value can be so different for the same business? That's going to be the focus of the balance of the webinar. But what it comes down to really is looking at your business through the eyes of a buyer and realize that their concerns are all related to risk. Next slide. So Chris Snyder at the Exit Planning Institute addresses that perceived risk by breaking it down into 4 categories. Essentially 4 areas where a business owner can focus their efforts, increase the value and saleability of their business. He calls these the 4 C's, or the 4 intangible capitals. And these are areas that make a business more attractive and or less risky to a wider group of buyers and investors. How your business performs in these 4 areas will determine if you're able to sell your business and how high or low in the range of multiples it's likely that someone will pay for it. So there are human capital, structural capital, customer capital, and social capital. We're going to discuss them separately, but it's important to understand that they are all related and codependent on each other. Now, there's nothing magic or even new about this concept. It's just that Snyder organized and qualified these characteristics that will not appear in reports pulled from your bookkeeping system, but will cause one business to be purchased at a premium while another business in the same market and industry sits untouched. Okay, next slide, please. So let's kick this off with human capital. Per the Exit Planning Institute, the formal definition of human capital is the talent, knowledge, skills, and experience of the employees within a business, including leadership, culture, and overall workforce engagement. We're going to illustrate this by picking on the smallest businesses on our call today, because typically they don't have employees, or at least very few. They're run by an owner, perhaps the owner's spouse, and maybe a non-family member or two as well. They may be incorporated and they may be paying themselves as a W-2 employee, but they still own a job. It may be a great job, but it is still a job. If they want to sell that business, buyers will decide if having this job is better than having their current job. Is taking on debt, giving up health benefits, a couple of weeks of vacation, and the ability to walk out the door on 5 p.m. on Friday and never think about their job until 9 a.m. on Monday worth being the captain of their own ship? It may or may not be, and this doesn't mean you can't sell your business if you're a solopreneur or a micro business, But remember that the 4 C's make business attractive to a wider audience. If you are the business, you're limited to finding a buyer with your skill set and drive, meaning that your potential buyer pool is much smaller. And when you do find a buyer, our experience has shown that you can expect a multiple in the neighborhood of 1 to 1.8 times the discretionary earnings upon the sale, assuming your business does well in the other 3 C's. Given that the median price for a Main Street business is typically between 2.3 and 2.5x, you can see the deficit in human capital lowers your value as compared to your valuation. Look, we understand most business owners still have a job or at least a role in their business, but if someone can step into the owner's role without negatively impacting the success of the business, either an employee or a new owner, the business will be much easier to sell. So your goal as a business owner should be to work your way out of a job, meaning you don't have to strive. You should strive to make yourself as insignificant as possible in the day-to-day operations of the business. This means that you need employees, specifically employees not related to you that are well-trained, experienced, and paid a fair market wage. A profitable business that has happy, well-paid professional employees is very attractive in the marketplace. We know that employees, human capital now, create complexity and overhead, and they can be frustrating, just like any other human endeavor. But they also move a company towards, or I should say, away from dependence on a business owner, and ideally prepared for growth. Next slide, please. The second C is structural capital. Per the Exit Planning Institute, they define structural capital as the tangible and intangible infrastructure that supports business operations, including documented processes, technology, systems, intellectual property, and organizational efficiency. If a business owner says it's all up here, for us, that's a problem. If you're, if you're a business owner, how you answer the following questions will indicate how your business looks in terms of structural capital, and will significantly impact your business value. Is there a bookkeeping or accounting system in place? Is it current and accurate? Are there documented SOPs, meaning this is how we do things here? They can be written. Matter of fact, we always just say written, but now video is a great substitute. Regardless, we want to make sure that everyone in the company knows how to find and use them for onboarding, training, and everything that needs to be done in the business. Are there financial controls in place? We've had clients discover employee embezzlement as a result of our valuation analysis. For one, that completely stopped any thought of a sale dead in its tracks for months. For another, the task of cleaning up was too overwhelming. They chose to close their doors rather than sell. How do you get new business? Do you have salespeople aside from the owner of the business? How are they paid? Do you have a marketing plan? How much and where do you spend your marketing dollars? Let me share a cautionary tale with you. How many people in the audience have heard a fellow business owner say they don't need to spend money on marketing because they get all the business they need through word of mouth? Everybody better have their hand up, because I hear this all the time. Or they don't have a salesperson because the owner does it. I will stipulate that they are saving money on marketing dollars and a salesperson's wages, but they're also paying a price. We had a business listed for sale that was owned and managed by a husband and wife team, just like Catherine and I. The business was profitable with a great reputation. We generated interest in the listing and hosted a buyer-seller meeting at our office. In this case, the buyers were also a husband and wife team, and they seemed to click with the sellers. The meeting was going great. Then the buyers asked, how do you get new clients? Both sellers were very proud of the fact that their marketing spend was absolutely minimal. They'd grown through word of mouth and reputation, and they did a great job. They did have a website, but they'd never really promoted it, and they'd never spent any significant money on marketing or advertising, and the business still delivered a very comfortable lifestyle for them. Then the wife, who ran the operations of the business, went even further. She was very proud of her husband and how good a salesman he was, how he knew everyone in town. He'd gone to high school there, and he was a great networker. I can personally confirm that the guy was he was a good dude and had natural charisma. The meeting ended on a high note, and I thought that our next step would be to write an offer. Unfortunately, in our next conversation, the buyer told me he was going to take a pass. He liked the sellers a lot, but he was afraid that he wouldn't be able to fill the husband's shoes, and definitely wasn't willing to bet his life savings on it. I'm not relating this story because I think that business partners, or spouses for that matter, should be negative about each other in public, but to illustrate the buyer's perception of risk. In my opinion, had there been a marketing plan, any marketing plan in place where the sellers could point to a clear ROI, the buyer might have had the confidence to move forward. And if there had been a productive outside salesperson working next to the seller, or ideally, instead of the seller, the odds of the buyer pulling the trigger would have gone up even more. Obviously, I don't have any way to prove that, but that's really what I believe. So to sum it up, can you answer yes to these following questions? If you were hit by a bus tomorrow, would the employees know what to do? Could the business continue to operate and grow? Would your asset be safe? If so, you're at least started to develop structural capital. Next one, please. Next slide. All right, customer capital. Again, Exit Planning Institute defines customer capital as the measure of strength of your relationships throughout your supply chain. The primary driver of customer capital is the relationships with your best customers, deep, integrated, open communication, shared goals and benefits. More questions for you. Do you have a lot of customers or very few? Does your business have multiple ways of creating income or revenue? Are you easily replaced by a competitor? Is doing business with your company an easy decision for your clients? Why or why not? Let's look at some common issues that impact customer capital. Client or customer concentration. Everyone loves big customers, but can they be too big? In our engagements, we flag any client or customer that makes up more than 10% of revenue. This or even higher level of concentration is not likely to prevent a sale, but the risk of losing 10% or more of top line revenue in one fell swoop will give any buyer pause. Of course, the other consideration with big important clients is that they frequently know it. And sometimes they demand significant discounts, so they also impact your margins. Or they can impact your margins. Diversity of revenue streams. Do you have multiple products, or can you serve multiple industries? When we owned a property management company, our focus was primarily on managing single-family homes. Growing that business organically was challenging because most single-family landlords only owned one or two properties. We had to make a lot of sales. On the other hand, apartment complexes have many doors in one place, and all those doors come in with one sale being made. They can also leave at one time too. So our strategy was to pursue a mix of these different products. Single-family homes hedged against the risk of multi-unit complexes where we could lose many doors at one time, and the apartment complexes were hedged against a hot real estate market where single-family homeowners were punching out of the real estate market left and right. And multi-unit complexes always stay in the rental market. We're providing the same service to a different market and diluting our risk. Is there a way to create recurring revenue? Do you have to sell your service over and over again, or can you make a single sale and keep getting paid on it? Is the revenue contractually obligated? Contractually obligated recurring revenue is the absolute gold standard in business valuation. All buyers want it, and assuming the other C's are reasonably in line, they'll pay a premium for it. Property management companies have been historically very valuable in the M&A market, mainly because there should be a management agreement in place that guarantees that the company owns the management relationship for a set amount of time. Our experience has been inertia is the management company and the buyer's friend in this case. If the buyer is competent, our experience has been that you're usually able to maintain that relationship and renew the management agreement with the property owners after the initial contract expired. There may be ways to create recurring revenue in your business, even if contracts are not typical in your industry. We've seen a private wine company create a subscription wine club where the customers are billed either $50 or $75 a month for a curated selection of wine. The revenue came in reliably on the first of every month, which covered the fundamental operating expenses of the store. The new owner loved that. Fabric stores create quilt-alongs or block of the month clubs for quilters. If anyone quilts or married a quilter, you know that revenue is recurring. A great resource for recurring revenue model ideas is The Automatic Customer by John Warlow. It's a super fast read, and he outlines 9, I think, recurring revenue models that can be adapted to many industries. It's definitely worth the read. Next point, are your clients sticky? Is it hard or even painful for your clients to change vendors? Anyone who's been in sales has been warned against commoditizing your products or services. Win it on price, you're going to lose it on price. That's what you always hear. But what if you're actually in a commodity business? We had a client that supplied commodity products, in this case, fasteners. These are items that are frequently sold by the pound and are a prime example of a market that could be disrupted by cheap imports. Think Amazon or Alibaba. Now, how did our client compete? They integrated themselves, or actually, I refer to it as they entangled themselves into their client's operational production processes. So Whether serving a manufacturer or a supply house, our client managed that customer inventory for them. They maintained their margins against competitors because the value-added work kept their clients from spending time and resources of their own internal people to manage that inventory. The longer they were there and the better they were at it, the more painful a change would be for their client. Next slide, please. Okay, social capital. This is the last one. Social capital is the strength of your company's culture. It represents how human, customer, and structural capitals are blended and optimized to create a flow and rhythm that self-perpetuates, driving and elevating your company to best in class. In short, this is all about your reputation and how people perceive your company in the community. How do you respond to these questions? Do you engage with your professional and local community? Are you and your staff engaged in thought leadership in your industry and the business community and locally? Is your business engaged in non-business aspects of the community? Do you sponsor Little League teams or charitable causes? The advertising doesn't matter. People want to know, are you engaged in the community? What's the perception of your business by your professional peers and competitors? Would they even want to be associated with your brand or reputation? That might seem a little harsh, but who's better positioned to take over your company than somebody who's already in your industry? Perhaps they're a company just like yours, but they're coming from outside the market and they want to expand. Maybe they're a local competitor and they want to absorb your customers, absorb your employees, and take another player off the board. Or maybe it's one of your competitors' managers. They know and love your industry, but they have the wrong last name and they don't have a path forward in their current business. The discussion of how you might sell to a strategic buyer is beyond the scope of this presentation, but we can say that it's done relatively frequently, and we are available if you have any questions. So what is your reputation in your market? In his book, Built to Sell, John Orlow talks about the Net Promoter Score, which is a measure of customer loyalty and thought to be predictive of business growth anyway. It consists of one question. How likely are you to recommend this business to a friend or colleague? Responses go from 0 to 10, where 0 is unhappy and likely to actively discourage others from using this company, and 10 being enthusiastic promoters of the company, very likely to recommend. This measurement is typically used by larger companies that are likely to have a lot of respondents, making the scores more statistically significant. An analog to the NPS, it is frequently considered by prospective buyers of small businesses, are the ratings posted by online rating platforms like Yelp, Google Reviews, and Better Business Bureau. And no matter your feelings about these sites or the business practices, and I have a lot of experience with Yelp, having been in the property management business, in our experience, these reviews will probably be considered by buyers of closely held companies. So what happens if you can't avoid bad social media reviews, or they already exist for your company? There's no easy answers. It's going to take time and effort. You're going to have to learn how to respond to negative reviews. I struggled with that personally. You're going to have to aggressively pursue positive reviews to dilute the negative ones. And I can't recommend this enough. Find and engage a marketing company that focuses on reputation management. By the way, that's a who, not how strategy. If you're actively trying to grow your business, it makes a lot of sense to hire somebody that's already good at a task rather than learning how to do it yourself. That completely goes against my nature, by the way. Who, Not How is a fantastic book. However you decide to deal with it, if online reviews are a challenge for your company, you're going to be asked about it by a buyer. So to bring this full circle, not much of what we spent the last 20 minutes discussing possibly show up in a business's income statements or balance sheets. We calculate a most probable selling price based on how a comparable business sold as a multiple of revenue, EBITDA, or discretionary earnings. But the comps databases can't tell us anything about how the company's performed in terms of those intangible capitals. But we know that intangible capital can prevent a business from selling, just as it can cause a business with lower profit to sell for more than an industry peer with higher profit. We need to be clear that no business is perfect. We sell imperfect businesses all the time, and we're absolutely confident in saying that the better a business performs in these categories, the more likely it is to sell and to sell for a better multiple. Next slide, please. So I've made the case that the 4 C's are important, but there's another equally important factor at play here: time. If we identify a laundry list of things that could make all the difference in the world to your business valuation, but you're 85 years old and have to sell your business now, what good is it? You need time to identify the changes, time to implement them, and time for the changes effect in the business and reflect the improved efficiency, higher revenues, better margins, etc. Sorry, I got to glitch. Okay, so the author, John Warlow, the founder of the Value Builder System, says it takes 5 to 7 years for an optimal business exit. This is for larger companies, but I think it's a useful exercise to step through. He says it takes 1 to 2 years or so of focus on the structure of the business, that is the 4 C's in the EPI world, making your business more attractive and transferable. The next 2 years are focused on increasing revenues and profitability. That task should be easier since you've already worked on the 4 C's. The next 1 to 2 years is focused on prepping the business for sale, preparing for diligence, reviewing supplier and customer and landlord agreements. Identify shortcomings and flaws in the business. I'm going to take a pause here. Just disclose and address any shortcomings, and your business is going to have them. In our industry, we call that go ugly early. Good buyers are going to find them anyway, so you might as well acknowledge them rather than appearing to hide them. Okay, next slide. Identify buyers, develop, execute a marketing plan. This is the role of the M&A advisor and business broker and intermediary. The final 2 years of the negotiation of the sale and the transition. Again, Warlow is typically talking about large organizations. In our experience, this time frame is relatively accurate, plus or minus a couple of years, for businesses that are doing well over $10 million in top line revenue. Smaller businesses have less to organize and will have shorter time frames. For a Main Street business with fewer than 20 or fewer employees, this time frame is more like 3 to 5 years, but the point is the same. You need to start now. Prepare your business to be ready when you want to go to market. A business needs at least 3 years of financial documents, tax returns, income statements, balance sheets to perform a valuation. Ideally, the 3 years reflect increasing revenues and profit. How long it takes to implement the changes in your business is dependent on how strong your business is in the 4 C's when you start. Are the necessary changes just fine-tuning, or are you fundamentally changing the way your business operates? How do you know where to start and what needs to get done? Well, contact us. We'd be happy to evaluate your 4 C's and give you some guidance on where you can best spend your time and resources. Next slide, please. Okay, so let's talk a little bit about your team. This is really a topic that warrants its own presentation, but I think it's worth spending some time on it now, just to get you thinking about it. Typically, we like to start with your wealth or financial advisor, which is maybe a little counterintuitive, but statistically, small business owners usually have between 60 and 80% of their net worth tied up in their business. The main point of this webinar is to help business owners start and to think about how they can harvest that value from the business when it's time to exit. So, do you know what you need in terms of assets in order to live the life you want after you sell your business? That's the job of your wealth advisor. They will evaluate the difference between where your personal wealth stands now, investments, savings, other assets, and income streams, and the total amount required to support your financial goals, lifestyle, and retirement needs. This is known as your wealth gap, and many business owners are counting on the sale of their business to close it. When a business owner receives a valuation for the business, they can compare what their business is worth now to where it needs to be when they retire in order to cover the wealth gap. This is called the value gap. If you believe, as we do, that your business is supposed to serve you and you're not supposed to serve your business, taking the time to engage your wealth manager or financial advisor to calculate these values will likely have a significant impact on your retirement. There are a ton of great advisors out there, but if you need recommendations, we can actually get you in touch with some good ones. Your M&A advisor intermediary, that's us. Your intermediary will be focused on business transactions. We work with the other members of your team, the CPAs, tax advisors, attorneys, and wealth advisors to plan your exit as smoothly and profitably as we can. Ultimately, our job is to walk next to the sellers through the entire sales engagement, valuation, marketing, and ultimately selling their business. Recently, though, we've focused on preparing business owners for transactions, ideally years in advance. That's why we're hosting today's webinar. We're trying to do more good for more people by encouraging them to start the planning process far earlier. Historically, the owner of a business reaches an arbitrary target age and engages to sell the business. He already has one foot out the door and his RV's picked out. Unfortunately, the only valuation he's ever had is the one we're doing right now as we prep the business for sale. And in many cases, Stuart gets to tell him the baby is ugly. It's worth less unfortunately, sometimes far less than what he and his financial planner were budgeting for. Many times, the seller markets a business at the price he was hoping for versus the price that's reasonably based on the cash flow, and it sits until he lowers the price or he just decides to close the doors. Our focus in these webinars is to change that dynamic by getting that valuation done early enough, long enough before an exit, so the business owner has the time to make changes and have them reflect in the financials. Or they can choose to change their retirement plans. Maybe they decide they'd rather retire now and just trim the retirement budget. At least they're the ones making the choice. All right, let's talk about your attorney. Most business owners already have a relationship with an attorney, or at least you should. As you consider exiting through a sale to a third party or otherwise, we strongly encourage our business owner clients to talk with their attorney regarding their specialization, specifically around the background of business transactions. An attorney supporting you in a transaction will review documents, write specific terms that are not included in stock contracts, and interpret complicated addendums. Most important, they can explain how the terms of the contract will impact you during and after the sale. This is especially important if you're being acquired by a large, sophisticated buyer who's proposing a complex deal structure. Our experience has been that strategic buyers, meaning that these are buyers that are already in your or related industry, have a preferred deal structure, and their attorneys know that model inside and out, and you can count on the fact that it's favorable to the buyer. You need a ringer on your side. Make sure that your attorney is open to working with the rest of your team, your intermediary, your tax advisor, and your wealth manager to facilitate the deal in a way that is most beneficial to you personally. Finally, remember that your attorney is not just for negotiating the purchase agreement. Do you know if your leases, vendor agreements, intellectual property, and client contracts are transferable to a future buyer? That work may need to start years in advance as you negotiate a lease renewal or multi-year agreements with vendors and clients. So your tax advisor, CPA, accountant. What I shared earlier about legal counsel and the importance of making sure that they have the skills and knowledge that you need in a business sale transaction is also true for your accounting and tax planning resources. Talk to your accountant about their comfort or desire to work on a transaction. Depending on the practice focus, you may want to talk about their bandwidth, that any available bandwidth they have during tax season when they may be facing extreme deadline pressure. Many CPAs, especially those that specialize in tax prep, are overloaded. There just aren't enough of them out there. For large transactions, getting the right advice early can save you a ton of money. Taking the time to model the impact of various deal structures will make you more confident in your negotiations and can have a major impact on what you get to keep after the sale of your business. Last story. We had a client who wanted to sell their business. The business was really profitable, had great employees, good structural capital. Their books were in order. As we got ready to list, we asked that they already discussed the potential transaction with the tax professional who specialized in business transactions. They hadn't, so we recommended an excellent resource from our professional network. This guy's a CPA and he only does transaction work. So we could better understand how deal structure might impact their sale. In the conversation with the tax advisor, we mentioned that our client's books would reflect a change to a subchapter C corporation filing 4 years ago. The advisor immediately started asking detailed questions about the company history and the change to the C Corp. It turns out that this business was a candidate for the exclusion of capital gains for the sale of a qualified small business stock. You'll hear people talk about a QSB, held for more than 5 years, meaning that there could be no capital gains on what we anticipated to be an $8 million sale of the business. One conversation saved this client $1.5 million in federal taxes just by delaying the listing for 9 months. It was a worthwhile conversation. Next slide, please. So wrapping it up. Again, the secret about exit planning is it's just good business and strategic planning. All the characteristics that make a business attractive to a buyer are the same characteristics that make a better, more profitable business that is more pleasant to run and takes less of your time. There's far more to exit planning than we've been able to present here. It's just too broad a subject to cover in 40 or 50 minutes. Rather, our intent in hosting today's meeting is to start thinking about how a buyer will view your business while you still have time to make adjustments that will make your business attractive and more valuable in the marketplace. Next slide. Okay, we made it. Thank you for joining us today. We hope you found the insights valuable, and hopefully we at least scared you into thinking about exit strategy. If you're ready to list your business, or you think that selling your business in the future might be a reasonable option, or if you just want to see how your business measures up in terms of the 4 intangible capitals, feel free to reach out to us after the webinar. We'd be delighted to talk to you. Now, I think Gene was planning to ask some, open up the floor for questions. Okay, I'm not sure where Gene went.
Okay, let's open up the floor for questions.
I'm sorry, Gene, I can barely hear you. Gene?
The floor is open for questions.
Okay.
Yes. Can you hear me?
Yes, I sure can. Now I can hear you.
Perfect. Okay, I see a few questions coming in.
Okay.
Christian in the room, how do I know if my business is truly ready for a formal valuation?
You don't, honestly. The fact is that we see people frequently that are, they bring the business to us, and maybe they're just started, they're just a couple years into it, and they're young, and they say, hey, you made a convincing case about the strategic value of evaluation, but if we glance at the books and the financials, it may be obvious that it's not time yet. I think I wish I had a really good way to quantify that, but I think it's worth having a conversation and just saying, yeah, it's time, and no, it's not time. Here's some things we want to look at. Let's talk in 6 months. Hope that answered your question, Christian.
Okay, there's the next question from Simon. What's the best way to identify and track the key drivers of my business value?
Honestly, I would read Walking to Destiny by Chris Snyder. That's kind of the textbook for the Exit Planning Institute, the CEPA certification. Really well written book. I would also read Built to Sell. That's John Warlow's main book. And you can engage with a Value Builders Advisor. Catherine's a Value Builders Advisor. That's not a big part of our practice, but it's a good way to look at your business and determine its. Snyder in the EPI book talks about the 4 intangible capitals. The Value Builder system, they have 8 drivers of business value, and it's they're both very valuable. But I think between those two, you can figure it out. And again, love to chat with you about that and how we can quantify those things. And you can engage. We have referrals to fantastic coaches that can speak directly to these 2 methods, or a third one. Here, if I could make a point about having another set of eyes on your business, I think that's very important. I'm a big believer in coaching. It's probably not going to be us because our focus is on transactions and valuations. But I'm a big believer in having another set of eyes that isn't emotionally involved in it to engage with you. Hope that helped.
There's another question from Carl Reed. How do I know if I'm undervaluing my business by being too involved in daily operations?
If you're involved in daily operations, you're paying a price in a decreased value. Now, the question is, to what degree? And this is not a digital thing. This is analog. In other words, as you move out to less and less involvement in your business on a day-to-day basis, the value goes, the value goes up and up. And that doesn't mean getting out of your business and kind of leaving it to the wolves and seeing how your people respond. That means taking the time and separating yourself. I mean, what I found, and Catherine and I found in our business, is that when you're deeply involved in day-to-day operations, you don't have time to engage in the thought work it takes to build these systems and to document these systems, right? So a book that that we both love is it's called Buy Back Your Time by Dan Martell. And he talks about, and it's an interesting mind shift. So instead of hiring to grow your business, you as the principal driver of your business, and if you're still in that place where you're kind of the hub of the wheel, the very first goal is to hire people that will get your time back so you can take the time it takes to do the thought work to build the systems that will make the business less dependent on you. So those are my thoughts on it. I wish I'd be more concise than that, but this is what you get. Sorry.
Okay, great. Moving on to John's question. Should I get a valuation done even if I'm not planning to sell soon?
I think so. Part of it, though, is the maturity of your business. In other words, we get people who've only got a year or two worth of financials. I don't think it's time. It's not worthwhile. However, if you've been in for several years, I think there's a hell of a lot of strategic value. If you can't tell by the haircut, I happen to be a Marine as well, although got out a long time ago. I'm more than a Marine. I'm a Marine plus like 50 pounds. But the first two steps in land navigation in the Marine Corps they teach is, first thing you do is orient the map. So that's looking at your marketplace. The second step is to find yourself on the map. That's your valuation. So if you can find yourself on the map, now you can say, look, my valuation is $1 million. And either through conversations with my financial planner, or just by the fact that I've got a number in mind, whatever it is, so you want to reach $5 million, you don't know how to get to $5 million until you know where you stand right now. That's the value of that's the value, and that's the strategic value of the valuation. If it couldn't be any more awkward than that, sorry. So hopefully that helps.
Okay, great. Lots more questions coming in now. What's the difference between book value and market value, and which one matters in a sale?
So when people talk about book value and market value, normally they're talking about the balance sheet, which is, what does it say according to the, what is the depreciation? How much depreciation have you taken? That doesn't necessarily describe the real value of the product. The market value is what matters, both, if you're looking at the value of the FF&E of a business, but also the market value of a business is what someone's willing to pay for it. So I'm sorry, is it Yuda or Judah? I'm not sure if I'm pronouncing that correctly. I apologize. I'm not sure if we could clarify that a little bit more. Sorry.
Okay, we'll move on to the next one. What should I focus on now if I want to increase my valuation over the next 12 to 24 months?
Probably the biggest, the single, if you had to pick one thing, I mean, ideally, we're human beings, we can do more. Well, most people, not necessarily me, can do more than one thing at a time. So I think you should probably pick 2 or tops 3 things to do. But if there's one thing you want to focus on, I think that you want to focus on increasing revenue and maintaining your margin, or improving your margin. But when I say improving your margin, I mean improving your margin in a way that someone else could respect. And I'm going to share a short story. We had a manufacturer that had, to put it politely, a very, very strong personality. He basically had 25 direct reports, because there's no way possible that anyone who is qualified to be middle management in his firm would ever work for him. So his profitability was through the roof, because basically he was not paying, 5 people between him, or 4 people between him and the frontline workers. That doesn't help you that doesn't help you, because sophisticated buyers come in and say, hey, great business, great profit, all that stuff, but they're going to dial in what it takes for a mortal to run this business, not some superhuman. So what I mean by that is that you need, build your sales, get your revenue up, but always maintain your margin, and don't maintain it falsely by having too few people or skimping on something. In other words, always look at your business through the eyes of a buyer, right? So you can decide, okay, how do we, if it, and you should always have in your mind that what is this going to look like just if I sell this business one day, right? That's the way I want to look at it. And if you can possibly increase your revenue, increase your profits, and maintain that mindset, I think that's going to go a long way.
Okay, great. Moving on. Okay, I'm just going to read. Frank says, tell us more about your marine background. Simon says,
I'm a jarhead. I'm an enlisted jarhead. I went to college for 4 years, spent 2 years digging a hole for myself and 2 years trying to dig out of it. And I got tired of people telling me what to do. So I went and joined the Marine Corps. And I was a very, very motivated college student again about 3 days later, but it was too late. So when I got out of the Marine Corps, I had a wife and a child. By the way, the same wife and the same first child as I have now. And I decided it was time for me to go to work. So I worked a variety of technical sales jobs because I did have the engineering background. So that's a very short story, background on me. Next one.
Simon says, thank you for that answer. Alfred says, would love to hear more about the 4 C's. Okay, and Juta, what percentage price should you ask for based on your profits?
That's Judah's questions. That's going to depend on your industry. So different businesses have, when we do evaluation, we go look at comparable transactions. There's a few states out there that actually have their own multiple listing service for businesses. Very few. California and Nevada are not 2 of them. That's where we primarily work. In which case we subscribe to databases that are transactions, that are lists of transactions that happened. There's deal stats, there's peer comps, there's biz comps and value comps. We look at all these business transactions and how those businesses sold as a percentage of their top line revenue, as a percentage of their discretionary earnings, as a percentage of their EBITDA, depending on which one applies. In other words, smaller businesses are typically sold and valued based on seller's discretionary earnings, typically because they have a very much an operation that the owner, the seller, has a very much an operational role in the business. The EBITDA number is typically for larger industries where the seller is still engaged with the business, but they don't have an operational role. In other words, they're not still pulling wires, sweating pipes. Hope that answers your question. Let me see. Is industry benchmarking important? I can actually see over here. Is industry benchmarking important when valuing a business? Yes and no. And what I mean by that is that, yes, to come up with that median value, because we've got to come up with something, but the industry benchmarking is going to be looked at like, hey, we're really performing, we're outperforming the industry significantly, like the manufacturer I told you about that had the 25 direct reports. His percentage, how he performed against the industry in terms of the labor costs was through the roof. It was absolutely insane. And sophisticated buyers, the first question they asked is, why is this so far out of whack? And then they figured out pretty quickly that there should have been 5 more executive level people, between management and executive level people between the seller and the frontline workers. So industry benchmarking, in other words, if you're in the ballpark and, if you're not way out of whack, it can help, it supports it, and it kind of goes to the 4 C's as well. Hope that helps. How long does it take for a business valuation typically take? Usually what we ask for is, depending on the size of the business, we can ask for as many as 7 years of financials. So these are 7 years of income statements, 7 years of balance sheets, 7 years of tax returns. These are much larger enterprises, and typically a trailing 12 months. The reason that's so long is, for a larger business like that, the buyers who can afford to buy a business like that are more interested in tracking the business's performance against economic trends. And so 7 years is kind of like your round figure, is like, we're going to see some ups and downs. How is it affected by the economy in general? Most businesses are 3 to 5 years, but we still collect those 3 to 5 years to do the valuation. After we get the financials, anywhere from a week to 10 business days, give or take. How much does customer concentration affect valuation? Again, it kind of depends. In general, it's customer concentration is a negative. On the other hand, are you the only person who can supply that product to that customer? And can you make that case compellingly? If you can't, if someone says, look, I've got a replacement product over here, then you guessed poorly. But like I said, it's generally considered a negative, but and it depends on, and to what degree is the customer concentration? Is it 70% of your business, or is it 18 to 15 to 18%? In other words, it's a sliding scale. In other words, one is much more concerning than the other. Hope that helps. Let me see. How does customer concentration affect? I've got that one. Which one, Kelly?
What role does EBITDA play in determining business valuation?
Did I? Okay, so I guess I missed that one. What role does EBITDA play in determining business valuation? It's generally speaking, most people are going to, for large-ish businesses, and if they're an EBITDA business, in other words, if it's a business that's large enough that the business seller doesn't have a day-to-day operational role in the business, and they're more of an executive role, almost all valuations are going to include an EBITDA multiple. I mean, and they may be using a discounted cash flow model. There's a lot of different ways to do it. So it kind of depends on the size. Now, a lot of people will look at a revenue model. In other words, hey, what's the revenue multiple? In some industries, it's just kind of a rule of thumb. For instance, accounting practices, for instance. You'll hear accountants will say, what are accounting practices? And before you finish the sentence, they'll say 1 to 1.5 times revenue. I think there's a couple of factors at play there. First off, they believe they're other accountants, so they're keeping the books pretty well. And the other thing is that they've all accepted it. Now, here's the downside of valuing a business by revenue. That means that a well-run business is valued the same as a poorly run business. And what I mean by that, if you have two businesses with $10 million revenue, one has an EBITDA of $2.5 million, so they get a 25% EBITDA off their revenue, and one has $1 million. If we're valuing it on revenue, they both get treated the same. So what we like to do is say, we usually use a revenue multiple as a sanity check against the EBITDA multiple. And another kind of fine point, if you will, is that it's a good check because, these databases we subscribe to, it'll give us, for every transaction, it'll give us an EBITDA multiple, an SD multiple, and a revenue multiple. And if the EBITDA multiple shows really high and the SD multiple is really low, what that means is the business is not as profitable as it should be, because ideally they should be relatively close to each other. So, I mean, there's some stuff you can love to chat with you about it if you want. Yes, Ashish, 10 years, 7 years is a long time, no question. But the fact is, depending on the size of the business and who's buying it, they may want to look, and again, they want to see an economic cycle and see the effect of the business on the economics, the effect of the economic cycle on the results of the business. So that's why they would do it. But no, typically you're right. 3 to 5 years is more common. Did we catch all of them, Jane?
I think a few of them are asking about if this is going to be posted on LinkedIn or YouTube. Interested in sharing
We did the last one on YouTube, didn't we, Gene?
Yes, I believe so. Yeah.
Yeah. So we'll have this, and I think Gene's the expert on that stuff. So what's going to happen, I think, is that we'll have the video. I don't know if we'll clean it up, maybe take some of my ums and ahs out, and then it'll be available on YouTube. And I think anyone who joined the webinar is going to get a copy of that. Is that correct, Gene?
Yeah. Yes, that's correct.
Okay.
Everybody will
Yeah. So that's the way it's going to work. Hopefully that made sense. Any other questions? Well, we hit it's 12:59. We hit exactly 1 hour.
Amazing. Thanks everybody for keeping this engaged and interacting. Thank you, Stuart. This has been an awesome webinar.
I really appreciate everyone joining. And again, thank you for your efforts, Gene, because I made you scramble right at the very beginning.
No problem at all.
Okay.
Yeah, so just a few more questions.
Hey, thanks everyone. By all means, if you have any questions, by all means, feel free to reach out. I nerd out on business, and so I'd love to chat with you about your business if you want, and if anybody knows anyone who would benefit from a conversation like this one, I like to think that we can contribute. So with that, I think I'm going to sign off. Thanks very much to everyone. Appreciate it. Bye-bye.
Thank you.